They say history doesn't repeat itself, but it often rhymes. And in the world of investing, it rhymes in fear, euphoria, and eventually regret. Take 2008, take 2020, or even the recent 2024 meltdown in Indian small-cap stocks. Each time, investors made the same mistake. They chased returns, ignored portfolio risk, and paid the price. But here's the thing. Portfolio risk doesn't show up in good times. It hides, quietly compounding beneath your gains, until one day it doesn't. Today, let's unravel the one thing that determines whether you build long-term wealth or become another cautionary tale. Portfolio risk, what it is, why we ignore it, and what you can do right now. Let's go back to 1999. The world was drunk on .com hype. Stocks like Pets.com and eToys were doubling in months. Investors believed the internet had changed the rules. From 1995 to 2000, the Nasdaq rose more than 400%. Then came the crash. 78% wiped out in less than 2 years. Fast forward to 2021. This time it was crypto, NFTs, and tech stocks. Everyone from college students to retired teachers was buying Bitcoin at $60K and betting on Cathie Wood's ARK Innovation ETF. Then came 2022. Bitcoin fell below $20K. ARK lost nearly 70% of its value. And yet in 2023-24, we saw it again, this time in India. Retail investors flooded into small caps, PSU stocks, and startup IPOs. Funds like Quant Small Cap delivered 60% plus returns. But by March 2025, a correction wiped out a year's worth of gains in just weeks. So why does this keep happening? Because while returns are visible and exciting, risk is invisible until it becomes overwhelming. We don't ignore risk because we're stupid. We ignore it because we're human. Cognitive biases blind us. Recency bias makes us think recent performance will continue forever. Overconfidence tricks us into believing we'll exit at the right time. FOMO, the fear of missing out, makes us follow the herd, even into fire. In 2021, Robinhood traders were pumping GameStop and AMC. In India, we were bidding IPOs blindly. Zomato, Nykaa, Paytm. Then came reality. Valuations didn't support the hype. Prices crashed. Retail investors exited at massive losses. The pattern is clear. Every bull run hides a risk bubble. The only question is, are you protected when it bursts? Portfolio risk isn't just about one bad stock. It's about concentration, correlation, and lack of resilience. Ask yourself, are you overly exposed to a single sector, like tech or small caps? Do all your investments move in the same direction when markets fall? Would a 20% drawdown make you panic? In 2008, equity-heavy portfolios fell 40% or more, but diversified ones, with gold, debt, global exposure, saw smaller declines and faster recoveries. In March 2025, when FEUs pulled money from India due to US inflation fears, Nifty Small Cap 250 fell over 15%. Meanwhile, gold ETFs and short-duration debt held firm. Investors with balanced portfolios slept better. So yes, market volatility is inevitable. But portfolio damage? That's optional if you manage risk. The best investors don't avoid risk, they balance it. Ray Dalio's all-weather portfolio is a great example. It holds just 30% equities and offsets them with bonds, gold, and commodities. Result? Steady returns across economic cycles with far less volatility. Norway's sovereign wealth fund, the world's largest, spreads its assets across 70-plus countries, different currencies, and asset classes. It's secret, not chasing hot trends, managing risk at the portfolio level. In India, funds like Parag Parikh FlexiCap avoided the 2022 tech crash because they had exposure to global equities and a value investing mindset. If the world's largest and smartest funds treat risk management as non-negotiable, why shouldn't you? Here's what you can do today. Scan your portfolio allocation. Use InDeMoney, Zerodha or Kuvera to see how diversified you really are. Add uncorrelated assets, a bit of gold, some debt funds, even international ETFs like Nasdaq 100 or S&P 500. Rebalance yearly. Trim your winners, reinvest in laggards. It's boring, but it works. And most importantly, ask yourself, if the market fell 30% tomorrow, would I survive? Or would I sell in panic? Great investing isn't about predicting the future. It's about preparing for it. Most investors chase returns. Smart investors measure risk. And the truly successful ones, they survive every cycle because their portfolio is built to last. If this gave you a fresh perspective, hit like, share it with someone who needs a risk check, and subscribe for more real-world investing insights. Because in the long run, the goal isn't just to grow your money, it's to protect it.